that goes for SACCOs as well. And how do
But just to start, I wanted to take us down memory lane just to see where we've come from. And as you can see, back in 2011, life was good. Private sector credit growth was at 36%, believe it or not. So you can see there was a lot of money sloshing around in the economy. I mean, banks were chasing people for loans. And but too much of a good thing is bad because part of the reason why the Kenya shilling depreciated by 25% that year was, I think there was excess liquidity as well. And then you can see we've come from the halcyon days of 35% private sector credit growth to where we are currently, 4%. So it's a far cry from where we were previously. So in this report, I looked at 5 aspects of private sector credit growth. The first aspect was private sector credit share, and it turned out to have some surprising findings actually. So starting with private sector credit share, in terms of Kenya, what we established was private households actually have the highest private sector credit share, highest share of private sector credit in the country, followed by the trade sector, and then manufacturing and real estate respectively. As a matter of fact, private households and the trade sector have a share of over 40% of private sector credit, not only in Kenya, but even if you look in the region, in Uganda and Tanzania. What was striking though here is that agriculture, despite being the largest economic activity in the region, contributing to 25% of GDP, only gets 4% credit share, private sector credit share. So there's a bit of a misbalance there. And then the other interesting takeaway here is manufacturing, despite getting double digit, a fair good share of private sector credit in Kenya, the manufacturing sector has continued to struggle in terms of GDP growth. And this indicates that the manufacturing sector has its own unique constraints that need to be looked into, because even the availability of private sector credit growth is inspiring the growth of the sector.